Strategy, the biggest corporate holder of Bitcoin on the planet, just posted what looks like a record breaking multi billion dollar profit. But on the same day that news should have sent their stock to the moon, it got absolutely hammered, dropping over 7%. This makes no sense, right? How can a company announce staggering profits and have Wall Street punish it in the same breath? Well, it turns out this bizarre paradox isn't a glitch. It's a warning shot. It's the first tremor from a financial earthquake building just beneath the surface of the crypto market. This isn't about inflation, it's not about interest rates, and it's not about the halving. This is about a boring, little known, brand new accounting rule that has created a ticking time bomb on the balance sheets of every public company holding Bitcoin. While the mainstream media and most influencers are completely asleep at the wheel, focused on the daily price chart, this new rule has created a hidden feedback loop that could trigger a catastrophic, forced sell off of Bitcoin by the very companies that have championed it the most. In this video, I'm going to show you exactly how this doomsday machine works. We'll break down the chain of events from an accountant's notepad to a potential market-wide liquidation and reveal the one risk that almost nobody sees coming. This is the story of how a solution became an even bigger problem and why the end of 2025 could be one of the most dangerous periods in Bitcoin's history. You need to understand this. To understand the danger we're in, you first have to get your head around the broken, nonsensical world we just left behind. For years, if a public company like Strategy or Tesla bought Bitcoin, they were forced to play by the most bizarre accounting rules imaginable. Imagine you own a classic car. You buy it for $50,000. The next year, its value skyrockets to $200,000. You're ecstatic, but if you were a public company, you wouldn't be allowed to tell your investors your car is now worth $200,000. On your official books, it's still stuck at its original price. Now, let's say the classic car market has a bad month, and the value of your car dips to $45,000 just for a moment before recovering. Under the old rules, you'd be forced to officially write down the value of your asset to $45,000. This is called an impairment charge. You have to declare a loss. But here's the truly insane part. Even if the car's value later shoots up to $300,000, you are never allowed to mark the value back up on your books. That $45,000 impairment loss is permanent. Your financial statements would forever carry that car at a fraction of its true worth, creating a completely distorted picture of your company's financial health. This was the reality for companies holding Bitcoin. They used what was called indefinite-lived intangible asset accounting. It was a one-way street to financial misery. They could only report losses, never gains. Every time Bitcoin had a volatile dip, even for a day, companies like Strategy had to take massive write-downs, reporting huge paper losses that made their quarterly earnings look like a disaster. Meanwhile, when Bitcoin was soaring, they couldn't report any of those spectacular unrealized gains. It was a system that actively punished companies for holding a volatile asset, and the crypto world rightfully hated it. For years, people begged the financial rule makers, the Financial Accounting Standards Board, or FASB, to fix this broken model. And in December of 2023, they got their wish. The FASB announced a new accounting standard, ASU 2023-08, introducing fair value accounting for crypto. It was celebrated as a landmark victory. The shackles were off. Finally, companies could report both the ups and the downs. This new standard becomes official for all companies for fiscal years beginning after December 15th, 2024. This means that for the entirety of 2025, a new game is being played. So, what is fair value accounting? It's simple, and on the surface, it sounds perfect. Under this new rule, at the end of every quarter, a company must look at the market price of Bitcoin and adjust the value of their holdings. If Bitcoin's price went up, the company reports an unrealized gain that flows to their net income. Their profits look bigger. If Bitcoin's price went down, they report an unrealized loss, which also hits their net income, making profits look smaller or even turning a profit into a massive loss. It seems like common sense. It's transparent. It reflects reality. But here's the massive twist everyone missed. This solution has created a new, far more dangerous problem. By piping the raw, unfiltered, face-ripping volatility of Bitcoin directly into the quiet, civilized world of quarterly corporate earnings, the FASB has inadvertently created a direct transmission mechanism for crypto chaos to infect the stock market in a way that's never been possible before. Before the damage was contained, the old rules were confusing, but they created a buffer that sophisticated investors knew to ignore. Now, there is no buffer. The volatility is no longer a footnote. It's the headline. And this newfound transparency is about to collide with a hidden danger in corporate finance: billions of dollars in complex debt. The fuse has been lit, and the market is about to discover the consequences of getting what they wished for. To see how this bomb is set to go off, we just have to look at the poster child of corporate Bitcoin adoption: strategy. This isn't just a hypothetical exercise, this is a live fire drill with billions of dollars on the line. First, let's be clear. On paper, Strategy is a business intelligence software company. In reality, since 2020, it has transformed itself into a leveraged Bitcoin acquisition vehicle. It's less a software company and more a de facto Bitcoin fund that can use debt to amplify its bet. And amplify, they did. As of mid November 2025, the company holds a staggering 649,870 Bitcoin. To put that in perspective, that's about 3.1% of the 21 million Bitcoin that will ever exist, all held by one public company. Their average purchase price is around $74,433 per coin. This means that as long as Bitcoin is above that price, they are in the green on paper, but their fate is now completely tied to Bitcoin's price. Now, let's run a very realistic scenario for the end of 2025 under these new rules. Imagine it's January 2026 and Strategy is about to report its Q4 2025 earnings. Let's say their actual software business has a decent quarter and posts a respectable operating profit of $50 million. In a normal world, that's a solid business. But now the new accounting rule kicks in. The company must mark to market its Bitcoin. Let's imagine that between October 1st and December 31st, 2025, Bitcoin has a standard run-of-the-mill crypto correction. Let's say the price falls 25% from $100,000 down to $75,000. Now do the math. Strategy holds 649,870 BTC. A price drop of $25,000 per coin means they must report a paper loss of over $16.2 billion. So when they release their earnings, the headline won't be "Strategy Software Business Earns $50 million." The headline, screamed across every financial news terminal, will be "Strategy Reports Catastrophic $16.2 billion loss." Do you think the market will care that this is an unrealized non-cash loss? Absolutely not. All they will see is the biggest, reddest number they have ever seen for a company of this size. The stock will plummet. It won't be a gentle slide. It will be a cliff dive. And right here, in this moment of panic, is where the real bomb goes off. You see, Strategy didn't just buy all this Bitcoin with spare cash. A huge portion was acquired by raising billions in debt, specifically using a popular instrument called a convertible note. Let's break this down because it's the absolute crux of the risk. A convertible note is like a loan with a special feature. An investor lends a company money, and in return, they get the option to convert that loan into a fixed number of shares of the company's stock at a set price. If the stock soars, the lender converts their debt to stock and makes a fortune. It's a great deal for everyone when the stock is going up. But what happens when the stock price crashes? Let's follow the steps. Step one, the trigger. The catastrophic earnings report showing a multi-billion-dollar paper loss hits the wires. Wall Street panics. Step two, the stock crash. Strategy stock, MSTR, gets obliterated, falling far below the conversion price on all those billions of dollars of convertible notes. Step three, the debt dilemma. Now put yourself in the shoes of the bondholder. You lent Strategy money hoping to convert it into valuable stock, but now the stock is in the gutter. Converting would be a terrible deal. Step four, the looming deadline. Here's the problem. Those convertible notes have a maturity date. While bondholders can't just demand their cash back tomorrow, they are now looking at a future where the company might not be able to pay them back. When billions of dollars in debt come due, a company with a crushed stock price can't just issue new stock to pay it off, and they'll struggle to get new loans. The market sees this coming from a mile away. Step five, the forced sell. This is the fatal blow. The market panics, realizing that Strategy is facing a future liquidity crisis. They have only one asset big enough to raise the billions in cash needed to satisfy their future debt obligations: their Bitcoin. They are forced to sell, not because they lost conviction, but because the mechanics of their debt structure, triggered by an accounting rule, painted them into a corner. They may have to dump tens of thousands of Bitcoin onto the open market to prove they can raise the cash to pay back the bondholders. This is the catastrophic sell-off nobody sees coming. It's not a choice. It's a forced liquidation. And what do you think happens to the price of Bitcoin when one of its largest holders starts selling on an industrial scale? The price of Bitcoin itself crashes. And that's when the real contagion begins, because strategy isn't the only one who played this game. When Bitcoin's price crashes from strategy's forced selling, it makes the balance sheets of every other public company holding Bitcoin look even worse. Companies like Metaplanet in Japan and other smaller firms that copied the playbook are now in the same boat. Their stocks get hammered, their debt looks risky, and they too could be forced to sell. It's a domino effect, a death spiral. An accounting rule creates a paper loss. The paper loss creates a stock crash. The stock crash creates a debt crisis. And the debt crisis forces a Bitcoin liquidation, which starts the whole cycle over again. Look, I know this is a lot to take in. It's complex, and it's the kind of detail you won't get from mainstream finance. They'll only report on this after it happens. If you're getting value from this deep dive and want to stay ahead of these hidden market moving events, do me a favor and hit that subscribe button and turn on notifications. It's free, and it's the best way to make sure you don't miss the next story everyone else is ignoring. So why is this a potential year-end catastrophe? The timing is everything. The new FASB rule is effective for 2025, meaning the Q4 and full year earnings reports released in January and February of 2026 will be the first big reveal under this hyper volatile regime. It's the Super Bowl of accounting, the moment of maximum headline risk. But another factor acts as a massive accelerant to this fire: tax loss harvesting. This is a common strategy where investors sell assets at a loss before the end of the year to reduce their tax bill. Now imagine Bitcoin is already trending down as we head into December 2025. A whole different set of players will start selling. Institutional funds and even companies might sell some Bitcoin at a loss to offset gains elsewhere in their portfolio. This creates natural seasonal selling pressure on Bitcoin towards the end of the year. It's like piling up dry tinder. The market becomes more fragile. A forced liquidation event hitting a market already weakened by seasonal tax selling is the recipe for a flash crash. And this brings us to the regulatory ghost. Regulators are almost always reactive. They don't fix the roof when the sun is shining. They write new codes after the building has collapsed. So imagine you're a regulator at the SEC. You just saw a company like Strategy report a $16 billion loss, watched its stock get cut in half, and saw it trigger a fire sale in a major asset, causing contagion. What do? You panic and you protect investors. This is where the whispers have already started. Major index providers like MSCI are already debating whether to exclude companies whose balance sheets are dominated by digital assets. JP Morgan has warned that if MSCI makes this change, it could trigger billions in forced selling of Strategy's stock as index funds are forced to dump their shares, adding even more fuel to the fire. It's not a huge leap to imagine regulators taking the next step. If they see this kind of volatility, they could easily propose rules that say, to be listed on a major US exchange, you cannot have more than X% of your treasury in an unregulated asset like Bitcoin. They would frame it as a necessary guardrail. The effect would be a death sentence for the corporate treasury strategy, presenting companies with a horrifying choice: sell your Bitcoin or get kicked off the stock market. The risk isn't just one bad quarter. The risk is that one bad quarter, amplified by new accounting rules and hidden debt, could give regulators all the ammunition they need to sever the link between the public stock market and the Bitcoin world for good. So, what does this all mean? First, this is not a video telling you to panic sell your Bitcoin. This is about awareness. The entire chain of risk we've walked through starts with something that sounds good: a fair value accounting rule. That rule introduces volatility into earnings. That volatility creates headline risk, crashing a stock. The crash creates a debt crisis, which forces the company to liquidate the only asset big enough to cover the debt, their Bitcoin. That forced selling crashes the price of Bitcoin, creating a domino effect. You now understand a complex structural risk to the market that 99% of participants have no clue about. They're driving by looking in the rearview mirror, talking about ETF flows. You're now looking at the map of the road ahead, and you can see the collapsed bridge. The solution for you is to understand that the adoption of Bitcoin by public companies, while a massive long-term positive, has introduced new and complex risks. The financial plumbing is where the real dangers lie, not in the daily sentiment charts. The price of Bitcoin is no longer just a function of retail buying. It is now also a function of corporate debt covenants and accounting standards. Now you understand the mess. You're prepared. You won't be surprised if in early 2026 you see a headline about a public company reporting a shocking multi-billion-dollar loss and the chaos that follows. You will know exactly what is happening and why. This is the power of real analysis over simplistic hype. The game has changed. The question is no longer if a company's debt could force it to sell its Bitcoin, but when and who will be first. Let me know your thoughts in the comments section below. I read every single one. And finally, if you appreciate this level of in-depth analysis, the best way to support the channel is to give this video a like and, most importantly, subscribe with the notification bell turned on. We'll be tracking this story all through the end of the year and into 2026. This is a story that is just beginning, and you will not want to miss the updates. Thanks for watching.